So now we focus on the taxation of employee income. How do we tax an employee income or individual income? Although the Act has not defined the term employment, it can be taken to mean any relationship between employer and employee arising from an agreement, whether expressed or implied in here a given year of income. However, the income tax has defined employment to include 1. Any person having control of payment of remuneration. 2. Any agent, manager, or other representative of any employer who is outside Kenya. 3. Any paying officer of government or other public authority. 4. Any trust, insurance company, or body of person paying pension. Any employee has also been defined by Act to include any holder of office for which remuneration is payable. 2. Any individual receiving emolument in respect of any employment, office, appointment, or past employment. So this actually gives us a clear information about who is employee, who is an employee, and what an employee represents in form of employment income. The Kenya income tax system adopts pay system where employee is under statutory duty to deduct the income tax on any income from employment or service rendered in particular year of income. The system applies to all cash emolument and all credits in respect of emolument to employees' account with their employers, no matter to what period they relate. So this is a critical system. Pay as you earn model is being used to actually effect the deduction of income from an employee. Section 5 subsection 1 subsection A of Income Tax Act clearly specifies the basis on which an income from employee is liable to income tax in Kenya as follows. 1. Cash payment, wages, salaries, leave pay, sick pay, payment in lieu of leave, director's fee, other fees, overtime, commission, bonuses, gratitudes, or pension, whether payable monthly or longer or shorter interval paid by the employer. Number 2 is cash allowance, house allowance, telephone allowance, commuting allowance, hardship allowance, cost of living allowance, entertainment allowance, etc., paid by employer. However, where allowances are paid as reimbursement with regard to the expenses paid by the course of duty by the employee on behalf of the employer, such allowances are not taxable on the employer. So you need to have this in mind. All other allowances are paid, but there are these expenses which are paid by the employee in duty when they are actually out there on duty. So when they are paying this amount, it is of essence that they will not be taxed when they are reimbursed. A personal expenditure, the amount of any private expenditure of employee paid by the employer, e.g., house rent, holiday bills, shopping bills, grocery bills, insurance premium, electricity, water, and telephone bills, school fees, etc., are taxable on the employee. So these are personal expenditures, and personal expenditures attracts tax. Any amount contributed by the employer on behalf of an employee to provide fund which is not registered with the Commission of Income Tax is taxable. However, for registered or approved fund, it is not taxable on the employee. So whichever has been registered cannot be taxed. But anything which has not been registered by the tax authority, then it has to be taxed. Now we have another section of taxable employment benefits. So taxable employment benefits include benefits whether in cash or in kind that is provided free by the employee to the employee or a person associated with the employee. The value of benefit received by the employee from his or her employer is subject to income tax. All benefits are taxable at higher cost of to the employer of providing the benefits and fair market value. Now, this is what actually we are trying to bring into our understanding. Taxable employment benefit. I may take one of the example so that we might have clear picture of what we are talking about taxable employment benefit. For instance, you've been employed, you have car allowance, you're using car or vehicle for your company which has almost 1.2 cc. So if it has 1.2 cc, we have regulation that says in tax rate, if your car is between 1,200 to 15,200, you are supposed to be taxed 4,200 or 50,400 per annum. So meaning that if so there are two scenarios. Either we use the valuation of the car original value, which actually it is normally taxed 2% of the original value, or the tax rate. So whichever is high will be picked as part of the valuation of the tax. Same to house allowance. If house is being used and you're supposed to be paying rent and you are not paying rent, so the value will be rated between the market value and the tax rate. So this is why we have taxable employment benefit as part of tax. So benefits which are taxed. For example, motor vehicle benefit, taxed at the higher of 2% per annum of the initial cost of the motor vehicle and the prescribed scale rate, which actually I've given. The prescribed scale rate, we have 1000 cc, 1.2 to 5, 1500 cc, 1500 to 1700 cc, how much will be valued or taxed at. Lease and hire vehicle are taxed at the cost of hiring or leasing the vehicle. Whether there is restricted use, the Commission may, upon application, determine the low rate based on usage. Non-cash benefits that exceeds aggregate value of 3,000 per annum or 36,000 per annum are taxable. However, a non-cash benefit of less than 36,000 per annum is not taxable on the employee. So any non-cash benefit which is less than 3,000 per annum per month or 36,000 per annum is not taxable. Anything above, assuming that you've been given non-cash benefit of 40,000, so the excess of 40,000, so you'll say 40,000 minus 36,000, you get this, then you are taxed for the excesses. Facilities, free lunches, free transport, gifts, etc. paid by the employee on behalf of employer are taxable at higher of the cost of providing the benefit and fair market value. So whichever is high will be taken as part of taxable liability. Servants, garden house help, gardeners, house help, security personnel, personal assistant, etc. provided for by employer to the employee are taxable at higher cost of providing for the servants and their fair market value. So whichever is high will be used as part of taxability. Domestic benefits, including staff meals, club subscription, water, electricity, etc., paid the employer are taxable at the highest cost or fair market value. The Commission has prescribed the value of benefit whether the cost to the employer is difficult to ascertain. The prescribed rates are: telephone includes 30% of cost to employer. Furniture is 1% of cost to employer. Water provided communally shillings 500 or shillings 2000 or shillings 200 for agricultural employees. Electricity provided communally shillings 1500 or 900 for agricultural employees. Taxable benefit on house benefit arise where employee is provided house by employer and taxed at the higher of market rental, actual rent paid, and for director 15% of total income, for all-time service director 15% of total emolument or employment income, for employees 15% of total employment income, agriculture employee 10% to the total employment income, where the total employment income exceeds 600,000 per annum. The rental benefit is higher of rent paid, and the fair market value. Rental received from the employee is deducted in calculating house benefit. Rental received. So assuming that the employee has rented the house to another person and he has been receiving income from renting the premises or the house, then that amount, rental income, should be included as part of the income. So what only we are deducting is the rent, which is supposed to be paid by the employer to the employee. Employee loans. Loan advanced by employee to the employee at a lower interest rate is taxable benefit on the employer. Loans granted after 11th June 1998 are subject to fringe benefit, taxable by the employer at the residential corporate tax of 30%. Low interest benefit, market interest rate less low interest times loan value minus taxable on the employer. Fringe tax benefit, prescribed rate minus tax interest paid times loan value times 30% minus taxable on the employer. Registered employee share ownership plan. This is a plan where employees are given opportunity to buy share of company. So we want to see